Somewhere along the line, we were all taught these supposed golden rules about money, rules about credit cards, saving, and investing that sounded so perfectly reasonable, you probably never even thought to question them. But what if I told you that a lot of those rules you've accepted for decades are actually completely backwards? Well, welcome to This Explainer. Today, we are peeling back the curtain on the absolutely biggest money lies you've ever been told, and we're going to look at what the actual facts say instead. We've got a lot of ground to cover to organize the chaos of typical financial advice into a structured roadmap. So first, we'll tackle credit and debt traps. Then we'll bust some massive housing and investing myths. After that, we'll look at spending, saving, and happiness before finally getting to the real financial truth. Let's get started. Okay, let's dive into this. Section 1, Credit and Debt Traps. We're going to look at the immediate, everyday traps that quietly cost people real money without them even realizing it. All right, so one of the most ridiculously expensive myths out there is this idea that leaving a small, unpaid balance on your credit card somehow proves your creditworthiness to lenders. It literally doesn't. The truth? You should absolutely pay your card off in full every single month. Credit scoring models are actually designed to reward on-time in-full payments. Carrying a balance just forces you to pay interest on money you didn't need to borrow in the first place. To understand exactly why that first lie is so damaging, we really need to understand credit utilization. This is simply the percentage of your available credit that you're currently using. Scoring models heavily reward low credit utilization. So keeping a balance on your card, it doesn't boost your score at all. It actually keeps your utilization higher than it needs to be, and basically just hands your hard-earned cash over to the credit card companies in totally useless interest payments. Now, speaking of credit cards, here is another huge trap. It feels incredibly responsible to tidy up your financial life by closing out old, unused accounts, right? Well, actually, scratch that. Ironically, this kind of financial tidying up works completely against you. Closing an old card reduces your total available credit, which instantly raises your credit utilization percentage. It also lowers the average age of your open accounts. So unless that ancient card carries a hefty annual fee, just keeping it open actually benefits your score. So what happens when things go wrong? The big lie here is that a high-limit credit card is just as good as a proper emergency fund. But the truth is, they solve completely different problems. A credit card is a high-interest loan, period. If you rely on that during a job loss or a sudden medical emergency, you risk creating a massive debt spiral because interest keeps piling up while you're already struggling. A cash emergency fund, on the other hand, is money you already own. There is zero repayment obligation attached to it. Which kind of brings us to a much broader misconception, the idea that all debt is universally dangerous and has to be avoided at all costs. The truth is way more nuanced. Not all debt behaves the same way. To really shift your perspective here, you have to realize that the purpose of the loan, the interest rate, and your ability to repay it matter so much more than the simple presence of debt on your balance sheet. And this brilliantly illustrates the difference. Think about it. On one hand, you have debt used to acquire appreciating assets or to increase your earning potential. We're talking about a mortgage or a reasonable student loan. But on the other hand, you have debt used for depreciating purchases or ongoing consumption, like putting your everyday living expenses on a high-interest credit card. One builds your long-term wealth, while the other completely drains it. Let's see how these concepts scale up into massive structural decisions. Section 2. Housing and investing myths. If you rent, you have almost certainly been told that renting is basically throwing your money down the drain. Society treats it like a moral failure sometimes. But let's reframe that right now. Renting is not wasted money. The absolute truth is that renting is a payment for a service. Just like you pay for your electricity or a haircut, you are buying shelter, flexibility, and the freedom to literally walk away without the massive burden of trying to sell a heavy asset. And that is because when you actually own a home, you are on the hook for all these hidden, unrecoverable costs. Property taxes, unexpected maintenance and repairs, insurance, closing costs, and mortgage interest. In fact, in the early years of a typical mortgage, the vast majority of your payment goes straight to the bank as interest, not toward your equity. Plus, homes do not automatically appreciate in value. Buying can be awesome, for sure, but it's a financial decision with severe trade-offs, not some universal rule where renting equals failure. Okay, here's another massive structural myth. The stock market. People constantly repeat the lie that the stock market is basically just gambling. Now, if you're day trading on random hunches on your phone, sure, that's incredibly risky. But the truth is that long-term diversified investing is fundamentally different from walking into a casino. Broad market indexes historically trend upward because they reflect overall economic growth over decades. The math completely proves the difference here. With gambling, you have a negative expected return. The house is mathematically guaranteed to win over time, and your bet has absolutely no connection to an underlying asset. But with investing, history shows an upward trend over long horizons. And why is that? Because you actually own a piece of a business. You literally own a fraction of a company that is actively producing goods, providing real services, and generating actual profits. So, let's transition into the emotional and lifestyle connections of our daily money mindsets. Section 3, spending, saving, and happiness. Ah, yes, the famous latte factor, the incredibly pervasive lie that cutting out your $5 daily coffee is the magical key to retiring as a millionaire. Now, while the math of compound interest isn't entirely wrong, let's be real for a second. Skipping your morning caffeine isn't going to buy you a private island. More importantly, the truth is that this framing just creates a ton of unnecessary guilt around minor daily pleasures, and it wildly distracts you from the big-ticket items that actually dictate your financial future. If you want to genuinely change your financial trajectory, you need to look at these four main drivers: your income levels, your housing costs, your transportation costs, and the interest rates on your debt. These are the true drivers of your long-term financial outcomes. Honestly, negotiating a lower interest rate, advancing your career, or buying a more affordable car will do infinitely more for your net worth than agonizing over a fancy coffee ever will. Now, what's really interesting here is something we usually celebrate. We've totally been conditioned to believe that getting a huge tax refund means we did a great job this year. It feels like a surprise bonus check from the universe, right? But the stark truth is, a big tax refund simply means you overpaid the government throughout the year. If you owe a small amount or get a tiny refund, it actually means your paycheck withholding was highly accurate. And here's the absolute irony of that massive refund: 0%. That is the exact amount of interest the government pays you for holding onto your overpaid tax money all year long. None. That's money that could have been sitting in your own bank account earning interest for you or paying down your own debt. Instead, you gave the tax authority a massive 0% loan. Let's touch on perhaps the most philosophical part of this explainer: the age-old lie, money can't buy happiness. The honest, nuanced truth here is that while money obviously doesn't guarantee happiness or fix every single emotional problem you have, financial security genuinely reduces a very specific, well-documented category of stress. I'm talking about the crushing, exhausting stress of not being able to pay for basic survival needs or unexpected emergencies. And we can actually ground this emotional argument in credible research. Major studies from Princeton and researcher Matthew Killingsworth in 2021 found that additional income consistently improves day-to-day emotional well-being. And for a lot of people, especially those who are already generally happy, that well-being continues to scale with income even well beyond previously assumed thresholds. Ultimately, money provides options, and options provide peace of mind. So, the absolutely crucial point is, where does all this myth-busting actually leave us? Let's wrap it all up in our final section: the real financial truth. You know, most of the myths we've covered today didn't spread because they were mathematically proven. They spread like wildfire simply because they were simple, clean, and sounded like common sense. But to break free of them, you have to develop a new habit. You need to actively question these so-called universal financial laws and look at your own numbers. Real personal finance is highly personal. It depends entirely on your unique interest rates, your specific timelines, your income, and your personal goals. Catchy cliches just won't build your wealth. Which brings us to our final thought. Which universal money rule are you going to stop blindly following today? Are you going to finally pay off that credit card balance? Stop feeling guilty about buying your morning coffee? Look at your numbers, empower yourself with the facts, and start making your money work for you. Thanks for joining me on this explainer, and I'll see you next time as we continue to decode the world around us.